In today's episode, we are going to talk about how to buy real estate through a self-directed IRA, meaning how to buy real estate through a retirement account. If you didn't know that you could, you actually can. This is an episode that you don't want to miss. We have Edwin Kelly here today with Specialized Trust Company, and he's going to be telling us what are some of the restrictions if you buy real estate through a self-directed IRA. What is the process of buying real estate through a self-directed IRA? Who can actually buy real estate in their retirement accounts? We're going to be talking about do's, don'ts. It's going to be an all-inclusive video. Welcome to the show, Edwin. How are you?
I am awesome, man. And that's a full agenda we got there.
Right? I love it. So let's briefly talk about what is a self-directed IRA, and can anybody buy real estate through their retirement account, or who can buy real estate through a retirement account?
Okay, great question. So I group accounts into two categories. There's what I call plain vanilla and truly self-directed. So a plain vanilla retirement account is the type that most Americans have. How do you know if it's plain vanilla or truly self-directed? Well, it depends on who holds the retirement account. So if you have your retirement account at a typical bank or brokerage, someplace that has a branch on every corner of every street, that's what I call the plain vanilla accounts. And the reason why I call them plain vanilla is that those financial institutions will only allow their clients to invest in marketable securities, things like stocks, bonds, mutual funds, and CDs, right? So if you have an IRA at your local bank or a big, national bank, and you said, "Hey, I want to buy real estate in my IRA," they'd say, "Okay, well, we offer REITs, which is basically a mutual fund for real estate," right? If you say, "No, I want to buy my own property in the IRA and rent it out and have the renter pay all the income tax protected back to my IRA," the bank is going to say one of two things: you can't do that, or you can't do that here, which is more accurate. You can't do it here, right? So by contrast, if you want to buy things like real estate, you need what we call a truly self-directed IRA. A truly self-directed IRA is one where the financial institution, so this is what we do at Specialized Trust Company, right? We are a self-directed IRA custodian. And what we allow clients to invest in is anything legally allowed by the government, which is virtually anything. But to make it simple, we're talking about specifically real estate today. So if you have your IRA self-directed at a self-directed custodian, then if you said, "Hey, I want to buy a rental property in my IRA and rent it out and have all the income go back to my IRA," we would say, "Sure, right, no problem." If you said, "I want to buy land," no problem. If you say, "I want to invest in commercial property," yes, right? So that's the difference between the two accounts. So it always comes down to the financial institution who holds your accounts. They're allowed to put restrictions on the rules. So the government wrote the rule book. We can do virtually anything you can imagine as long as we do it according to the rules. As long as we're doing it according to the rules, a self-directed custodian will allow you to invest in anything allowed by the government. Well, Specialized will. That's not true of all self-directed custodians. Some people do have their limitations. Plain vanilla is going to be limiting you basically to those mutual funds, stocks, bonds, and CDs.
Got it. And then if somebody already has a specific custodian through their employer, at what point are they able to roll it over into a self-directed self-directed account, a truly self-directed?
Yeah, so if it's a company-sponsored plan like a 401k, a 403b, a TSP, right, something along those lines, you have to have, generally speaking, a qualifying event. Okay, so there's various qualifying events. I would say probably the three most common that we see, and there's several, but to give you just the three most common, the number one is separation from the employer. So if you separate from the employer, so if it's a 401k from a employer that you worked at, last year or a few years ago, you can move that money out. If it's a current employer, that's typically where the restriction is in place. Now, if it is a current employer, there are still two qualifying events that I'll mention. One is a divorce. So what can happen in the event of divorce is that the court issues something called a quadro. Okay, it's a legal order to split the account, and in that case, the money comes out of the account, right? Um, because it's actually court ordered. So that's another qualifying event for some people, right? Hopefully, that's not one that you ever have to
Hmm.
encounter. Don't recommend doing that. Um, and then the third one is what's called an in-service distribution. So actually, I just got a text from a client who was asking about a transaction. It's actually a real estate transaction he wants to structure with his retirement account. He pointed out, he said, "Hey, I'm 62 years old. Does that play a role?" Well, the reason why he's bringing that up is that the way the rules work is that once you turn 59 and a half, even if you're still currently employed, you can generally move your money out. When I say your money, that means your contributions. The employer matching contributions that might have been made on your behalf, those typically have to stay in the plan so long as you're employed there. But your contributions, you can do an in-service distribution after age 59 and a half.
That's amazing. I actually didn't know about the divorce one, and I didn't know about the 59 and a half. So I think that's great information. The other one is if you are the owner of the plan, you could actually switch the plan for the entire company. Like for me being self-employed or having my own company, since I'm the owner of the company, I could actually switch the plan for the entire company to make it truly self-directed, or basically switch custodians, right?
Yeah, and so if you own the business, right, all of this changes because when you own the business, you have the ability to you're the decision maker. So yeah, you have way more flexibility and freedom if it's your business versus if you work for someone else.
And I think that for me was big because I had money in a 401k account. I was able to roll it over. Now I'm able to invest in anything legal and allowed by the government, which that was wonderful. So let's get into the topic. I wanted to just clarify that for our viewers. So in case you're wondering, like, okay, would I be able to do this? Now you've got a little bit of guidance. If you are able to do this or know somebody, now it opens up a couple more doors. So what type of real estate can somebody invest in? Is it open to commercial, industrial, residential, multifamily, self-storage, mobile home parks, anything? Or are there any restrictions? And can it be an owner-occupied property, or does it have to be for investment purposes?
Yeah, so great questions. So the way it works when the government wrote the rule book on retirement accounts and they wrote the regulations, which basically come from Internal Revenue Code 4975 and 408, right? And I don't want to get too technical here because that'll bore everybody to death. So we're not going to do that. But just as a point of reference, 4975, 408 is the Internal Revenue Code that we look at to read and understand the rules around what we can and cannot do with our retirement accounts. Now, beyond that, um, there's IRS letter rulings, there's court cases, right? There's things that we can look at um, beyond that, but that's basically where the rules are housed. So the way they wrote the rules, and I'll give you an example. The government doesn't tell us what to do. The government tells us what not to do. So as an example, there's no law that says I have to treat people nice, right? I don't have to be nice to anybody. I can be a jerk if I want to. And if I was a jerk to somebody and that person called the police and said, "Hey, Edwin was a jerk to me," the police are going to say, "Well, avoid him." Right? And no crime has been committed. By contrast, if I walked up and I slapped somebody, they could call the police and say, "Hey, I just got assaulted." Now the police can arrest me because a crime has been committed because there's a specific law that says you cannot physically violate somebody's person. So what we're looking at are the don'ts, not the do's. So there's no don't regarding real estate as an asset class, which is one reason why, again, I'll go back to the example I gave you earlier. Oftentimes when clients will say, "Well, I think I already have a self-directed IRA." Well, where's it at? And they'll tell me the name of their bank or brokerage. I'm like, "That's not self-directed." And they'll say, "Well, they said I could invest in real estate." And I said, "Yeah, they mean a REIT." Right? So the point of that is to say real estate as an asset class is not prohibited, right? You can go to a bank and invest in a REIT, which is basically a mutual fund for real estate. Now, most clients that we work with obviously have no interest in REITs. That's not what they're looking at. They want to be more involved in the transaction, or they're lending and investing, right, with a real estate investment professional like you, right, because you do this. Um, And so real estate as an asset class is not prohibited, and that's what the don'ts in the rules are called prohibited transactions. And when you're around the space for a while, some people will just abbreviate it by calling it PTs. So that's just jargon. The technical term is prohibited transactions. So prohibited transactions are the don'ts. So there's nothing in the rules that says you're not allowed to invest in real estate, right? That doesn't exist. Mm-hmm. So we're allowed to draw the conclusion, right, that it is possible to invest in real estate through our retirement accounts, and people do it every single day.
Got it. Okay. And then just to clarify, any type of real estate is allowable, basically. Now, let's say that I want to buy a property through my self-directed or through a self-directed account. How is the title taken? Is the title taken under my name? Is it taken under the name of my retirement account? And then what does that process work as well, too? Like, am I allowed to borrow money? Am I allowed to personally guarantee that money? What does that look like as well, too?
Yeah, so I'm going to use you, Jose, as an example for this because you're a great example. So when I'm talking to folks and they're trying to get this straight in their head, like how does this work and the process? In fact, I got this question the other day, so it comes up every once in a while. Well, wait a minute. If I have the money and I take it out of the account and buy the real estate, when I take it out, doesn't it get taxed? Right? Aren't I going to pay taxes and penalties if I take it out of the account? So what I tell people is the first decision you have to make when you're buying any investment, and we're going to be specific to real estate today. So I'm just going to talk about real estate. If you're going to buy an investment property, you specifically, Jose, have 3 places that you could choose to purchase that property. So the first decision is, who do you want to get the rights, the responsibilities, and the rewards of this specific investment? So the first place you could do it is in your own personal name, right? So probably everybody listening here has bought real estate, purchased real estate at some point in their past, probably own something currently, and they bought it in their own personal name. So that's one place you could do it. Second place that you could do it specifically, right, is you have an entity set up. You probably have multiple entities set up, right? So you know that an entity can take title to real estate. So you could have an LLC or an LP or a C Corp or whatever, and that entity could purchase that piece of real estate. The third place that you have is your self-directed retirement account, right? So you could purchase that property in your self-directed retirement account. So the beginning of the process, the very first step is to understand that you have multiple places, and this is why I'm saying this, because I want to eliminate confusion. Who do you want to own and receive the benefits of that investment? For today's purposes, we're going to assume is going to be the IRA, right? So in your case, what you would do, you have a couple of different options. You could buy that real estate directly in the name of your retirement account. So it would be Specialized Trust Company, FBO, stands for the benefit of, Jose's IRA, and the account number, right? That's one way you could take title. And I'll say that probably about 95% of our clients take direct title to assets in the name of their retirement accounts, okay? Most people do it that way. The way some people do it is they'll use an entity in between the asset, that piece of real estate, and their retirement account. So some people use LLCs as an example. Some people like to take title in a land trust. So you can insert another step, if you will, in that transaction. Like I said, only about 5% of clients do that, but that's also a possibility as well.
Got it. Now, am I able to do a personal, meaning do all lenders land on a self-directed IRA account, or are there specific lenders that lend on self-directed accounts? And am I able to personally guarantee the loan as well too, as an individual on a self-directed?
First thing is that there's 3 ways to use a self-directed retirement account to structure an investment, right, in real estate. So one way is an outright purchase. So let me just give some numbers for illustration purposes. Let's say you want to purchase a property. It's $80,000 to purchase, $20,000 to get it rent ready. And my first question to you is, okay, Jose, how much cash available do you have right now in your account? And you say to me, I've got $120,000 cash available. Okay, then the first investment structure is an outright purchase. because you have enough cash, right? It's cash for keys. You have enough to do that transaction. Let's say you come to me and you say, we're going to change up that scenario, right? You say, Edwin, hey, I've got, I want to buy this property, right? I need 100,000 all in. However, I only have $60,000 in my retirement account. So does that mean I'm out of luck? Okay. I say to you, well, Jose, does your spouse, does your wife have a retirement account? Yes, she does. How much cash available does she have? Well, she's only got 60,000. So she can't do it either. So this is the second investment structure. It's called a partnership or a joint venture. You can partner your retirement account with another retirement account, another entity, another person. So in that case, your retirement account would own an undivided interest in the transaction, and the other partner would have their own interest in the transaction. So it's a way of deploying, cash that you have, even if you don't have enough, or if there's multiple partners or people that want to go into the transaction. Lots of ways you can use that strategy, right? Okay, let's change up that scenario one last time, third time. You say, Edwin, I want to buy this property. I need 100,000. I've got 60,000 cash available in my account. My wife's account's fully invested. No cash available right now. Does that mean I'm out of luck? No. So here comes the third investment structure. I call it leverage. Leverage. So believe it or not, if you don't have enough cash in your retirement account to do an investment, or you just don't want to use all your own cash, you don't have to. Your retirement account is allowed to borrow it. Now, this is an extremely powerful strategy when used wisely, and I'll explain why. Number one, it is a legal backdoor to the contribution limit on these accounts. The only complaint I ever hear about retirement accounts is people say, well, the contribution limits aren't as high as I'd like, and if I'm just starting out and putting some money in there, I may not be able to buy a piece of real estate yet, right? I may not have enough to pay cash. So this is a legal way to bring more funds in to do that transaction, right? There's two things you need to know about borrowing money inside of an IRA. The first, and this is going to address part of your question, because you said, can I personally guarantee the loan? The answer is no, you cannot. In fact, this is another aspect of when we're done here, I owe this client a phone call later. We're going to talk about this transaction he's trying to put together. And so the question came up, right? Can I personally guarantee the loan? And the answer is no. Because remember, the rules tell us what we cannot do. They don't tell us what we can do. So is there a rule written in the code regarding borrowing in the account? Yes, there is. What does the rule state? The rule states you as the IRA owner are not allowed to extend credit, meaning personally guarantee a loan for your IRA or retirement account, and your IRA cannot personally guarantee a loan for your retirement account. So we need what's called a non-recourse loan. A non-recourse loan has language in it, something to the effect that says, in the event of default, the lender agrees to take back the property for full satisfaction of the debt. There's no additional recourse to the IRA or the IRA owner. So it's a very advantageous loan to have, right? It's kind of like it's basically a commercial loan, right? It's basically what it is. So if people are familiar with commercial lending, then you're familiar with non-recourse loans to IRAs, effectively, right? Okay, second thing, it will trigger in the IRA something called UDFI. UDFI is a tax. It stands for Unrelated Debt Finance Income. Some people call it UBIT. It's associated with UBIT. So most people don't know the term UDFI, but they do have heard, if they've heard about self-directing, this term UBIT. It will trigger the tax, and I'll say you may pay some tax. The reason why I say it that way is, as everyone knows, when you invest in real estate, you get to take write-offs. And so in many cases, right, real estate is a great tax write-off. So that's why I say you would trigger the tax, and you may or may not pay tax, right? Because then you have to file a tax return called a 990T for your IRA. And that tax only exists as long as the loan is in place. When the loan is paid off, that goes away, all right? A year after that loan is paid off. Now, having said that, if you said to me, well, Edwin, I really like this idea. Like I could quickly amass like a multi-million dollar portfolio using leverage to buy real estate, but I'd really like to avoid the tax. Is there a way to do that? The answer is, in some cases, yes. One of the ways that we avoid the or help clients kind of look at this is that if the loan meets certain criteria, which basically means it can't be a prohibited transaction, to kind of oversimplify it, if you were to do that transaction, instead of doing it in an IRA, you did it in a 401k, which we offer Roth 401ks, individual 401ks, solo 401ks, right? It's all the same thing, but it goes by different monikers. That UDFI does not apply. So when we do plan designs for clients, we look at a variety of factors in creating a custom plan design for a client. So we want to know, we ask, quite a few questions to really understand you as an individual, your family situation, your professional situation. We want to understand what are some of the investments you're thinking about doing or that you might want to do. And then we actually create a custom plan design that incorporates all of those things. It's kind of like your wish list, right? So when clients say, hey, I like this idea of potentially borrowing money in the account, then if they qualify, we're going to suggest that they look at that 401k because that's going to save them filing a tax return and potential money in taxes.
Yeah. The other thing as well too that I'm thinking about, like let's say that I bought a property, an apartment complex for $4 million with $150,000 down and owner financing on it. I could have potentially done that in my self-directed account, and then if I sell it 3 years later, let's say it gained $2 million, I could essentially sell and not pay any taxes on the sale because it's in my retirement account, right?
Exactly.
Which means that if I sell it now, I would have to pay taxes on it. But if I bought it through my self-directed account, it can grow tax-free basically. So then I can find a different investment now with those $2 million. And I just grew my $150,000 to $2 million, which is very hard to get that type of return in the stock market or just other types of investments, basically.
Yeah, you have to be involved in the investment and you have to know what you're doing to generate those types of returns. And we have a lot of clients who do those very types of transactions, right, that see returns like that. The self-directed part is each client makes their own investment decisions. And so a lot of your success is based on what you know, who you know, and how you do things, right? Those are really the determinants. Now, the great thing, though, about it is, and this is what I always like to point out to people, look, people like Jose, people like me, we weren't born with this knowledge. We learned it. Mm-hmm. And so what I will say is that, and this was one of our previous conversations, right? I alluded to that. I said, look, if you have a desire to be wealthy, if you have a desire to be financially independent, if you have a desire to manage your own money because you believe that nobody cares more about your money and your financial future than you, mm-hmm. then all this stuff is learnable, right? Every you can learn anything. So that's really the criteria. But yeah. The transaction you just pointed out, like those are the types of transactions that you can structure. That's a leveraged transaction. 100%, I would tell you do that in a Roth 401k, not an IRA. Having said that, though, is it a good deal in the IRA? Yeah, it is. Because to your point, even if you had to pay some tax on that transaction, even after the tax, what other investment could you do to take your account, say, and let's just go high. Let's just say you paid $1 million in taxes, which it wouldn't be that high, but let's just say it was. Well, if you go from 150,000 to 1,150,000 in 2 years or 3 years, whatever that time frame is, what other investment could you do to grow it that fast, that large? And if you have an answer, I'd say then do that one instead. But if not, like think about that. Now you've got 1,100,000 in equity to go invest in the next transaction. So think about how fast, and I mean, I teach a class called Accelerated Wealth, and this is what I mean by accelerated. When we're so used to living in a taxable world that when you eliminate taxes from the equation, people have no idea how fast they can grow their wealth because they're just so used to the taxes eating it up. But once they start self-directing their own account and they start to have success and see their investments and their accounts grow, it's not uncommon. I'll get calls and people will be actually nervous, like, man, my account's growing so fast. Do I have a problem? Like, am I going to get audited? And I'm like, why would you get audited? Well, because my account's grown so fast. It's like, well, no. I mean, if you're doing everything according to the rules, then yeah, there's no issues there. So
let's continue talking about the rules. So we made that point that you can buy and sell real estate in your self-directed account. What about flipping? What are the rules for or against flipping? Like, meaning, like, could I do 10 flips a year through a self-directed account? Could I do one flip a year? Am I technically even allowed to do what's called a flip, or is it more for long-term purposes? Or let's talk about that.
Great question. And this is something that comes up, and you're going to hear different opinions and perspectives on this. So I'll tell you how. So I'm going to answer your question the way I like to answer it. I think my way of answering it is the most accurate way. What I will say is, if you're doing anything and you have questions about it, consult an attorney or a tax advisor who can give you the guidance on the type of transaction you're doing, so that way you're just fully aware of whatever the implications are, right? That's all. So here's how I look at it, is that going back to the UBIT tax, so businesses are not prohibited inside of a retirement account. There was a case, and actually where this all came from, and this is where the UBIT tax actually came from, so I'll give you a brief history on UBIT tax. So many years ago, NYU, New York University, which is a tax-exempt organization, right, because they're supposedly for the public good. That's argued these days by some people. But regardless, right, tax-exempt organization. Usually when people make gifts to the university, they make them in the form of cash gifts, right? Well, there was a gentleman, and he had bequeathed his actual company, a pasta company, to NYU. So NYU ended up acquiring this business. And they said, hey, this is awesome because we're tax exempt. This is a business that generates all this business income. We don't have to pay taxes on it anymore. And the government stepped in and said, wait, hold on just a second. The reason why you're tax exempt is because of the public good that you do, right? You're an educational institution. You don't have tax exempt status to run a business. And in fact, it would put all competitors at a competitive disadvantage if you didn't pay some sort of tax on that business, right? So to level the playing field, we're not going to prohibit a tax-exempt organization or a tax-protected organization from owning a business. However, the business still has to pay tax. But what happens is, so the business generates income, it pays tax, and then those profits, earnings, whatever, get distributed back to the account. Now, from that point forward, those earnings no longer taxed. Now, the reason why I'm laying that foundation here is because businesses are always taxable. Investments are not taxable. So the question is, and this is where the debate comes in with flipping, are you operating a business in your account, or is that an investment? I can't answer that question for you. I can just tell you basically the way the rules are written. Businesses you can do, but they are taxable. Investments are not taxable. Here's where I could draw a clear line for you. So take my client. He's 62 years old. He's a real estate investor. He's got a business, right? He does very, very well, right, financially. When he turned 59 and a half, if he closed down his business and all of a sudden all the transactions that he was doing in his business appear in the retirement account, what do you think the government's going to say?
It's a business.
You're running a business. You just moved it into the account. And I would agree with the government in that scenario, right? So that's an extreme example, right? And so what you're really asking about, because I've heard there's some people say, well, if you do 5 flips a year, you're fine. I've heard some people say 10 flips a year, it's fine.
I've even heard one. If you do 1 flip a year, you're fine.
Right. So like people throw out different numbers, and I'm like, show me in the code where there's a number. right? I don't see in the code where there's a number. I do see in the code that businesses are taxable. And what the IRS will argue, if they audit you and they think you're operating a business, that's what they're going to argue. You're operating a business, you can do it, but you have to pay taxes on those gains.
Same thing I would imagine would go for wholesaling, right? If it's a business, basically, if it could be perceived as a business, then who wouldn't, like if I buy a property, like if I own a flipping company and I happen to buy one inside my self-directed IRA, is that technically could be looked as an extension of my business, basically, because I own a flipping company?
If they wanted to argue that, they could. Now, remember that the onus is on them to prove that in court, right? And when I say them, it would be the IRS bringing the case. That's why I say I would just run it by your attorney and say, hey, I'd like to do these types of transactions in my retirement account. Do you think this would trigger the tax or not? And your attorney will say, well, I think if you do whatever, it's fine. If you do whatever, could raise some flags. Okay, then you can decide if you agree with your attorney or not on that. But the bigger question is, I had a client several years ago, back in 2004. He opened up a Roth IRA.
Mm-hmm.
It was his first retirement account ever. He never had one before. 53 years old. He's like, man, I need to make up for lost time. So he had a very simple plan. I don't want to work the rest of my life. What I'm going to do is I'm going to use this tax-free account to generate tax-free income in the future. And the way I'm going to do that is I'm going to buy rental properties, Section 8. That's what he decided to do. And because he said, I want a predictable, reliable income stream. So I know what a 3-bedroom, 2-bath pays. I know the government's going to guarantee the rent. And so that's what I'm going to do. I'm going to accumulate these in the retirement account, in my Roth IRA. And then that's how I'm going to replace my money or my income. And I can do that in 7 to 10 years. Great strategy, right? Except there's one problem. He made a $4,000 contribution because that's all you could do in 2004. You can't build a real estate portfolio with $4,000 unless you get a little creative. So again, this is where, like we talk about these investment structures to help people map this out. This is why I say leverage can be a super powerful strategy when used wisely. So what he did was he went out and raised private money. And he said, look, you can use your IRA to make a loan to my IRA. And the way we'll do it is your IRA will own a note. My IRA will own the property. I'm going to take the rental income and pay off your note. That's how I'm going to pay you, right? And you're going to make a return, and it's all going to be tax protected in your account, and then I'm going to own the property outright. Just because of, like I said, I don't want to make any earnings claims here or whatever, but what I will tell you is that particular client, that gentleman, has a better lifestyle in retirement than when he was working. His income actually went significantly up because he was able to acquire so many properties, number one. He wisely used leverage to acquire those properties, 2. And 3, all the income that he generates every single month, because it's coming from a Roth and he's eligible to take qualified distributions, comes out 100% income tax free. Income tax free, capital gains tax free, no tax at all. Every once in a while, I'd have him talk or share his experience, right, and what he did and how he went about it. And people would ask the UBIT question. Well, but didn't you trigger UBIT? But why would I care? He said, you show me another way to make the monthly income I'm making right now tax-free for the rest of my life. He's like, I couldn't come up with anything else. So he says, don't let, the tail wag the dog. I mean, and that's why I say, is UBIT a consideration? 100%. But you actually have to look at what the goal is, what your goal is, what you want to achieve, and are there better options to achieve it, or does that option work just fine if you happen to trigger some taxes along the way? Because eventually you'll get to a point where you don't trigger taxes anymore, right?
Yeah. And then for the UBIT, is that equivalent to like what I would pay if I was running a business? Like, is that equivalent taxes to that? Is that a lower tax rate typically?
No. So the answer is it varies. So UBIT so IRAs and retirement accounts are a trust, special type of trust, right? Specialized type of trust, hence the name specialized. That was real clever, wasn't it?
How
Like, you
creative,
know how
right?
creative I am. Right? Specialized trust is what an IRA or a retirement account is. Like,
Oh, that's
so
so
there you go.
funny.
That's the name. Um, but so when you trigger tax in an IRA, you are paying trust tax rates. So it varies. So it's a bracketed rate based on income and variables and some of those things. So the first pass that we always make when clients are talking about doing anything that triggers, again, if it's UBI is a different issue than UBIT. We look at the account type first. But then, if let's say it is something that's going to trigger UBIT, just like Gary, who I mentioned earlier, he did the math. He said, this is where I can get. If I have to pay some tax along the way, that's how I get to basically having tax-free income for the rest of my life. And I can get there in a relatively short period of time by using this strategy. There's no other strategy I'm aware of that I can get to the same place in the same time frame. So I don't care. I'm looking at the end result. I don't care, that there's going to be some expenses along the way. It's the cost of doing business.
And would those taxes be paid from the retirement account or through like my personal? So it would be paid through the retirement account. So it's just basically the cost of doing business. Okay. So let's talk about like income. Whatever income, let's say I buy a property, that income cannot be paid out to me at the present moment. It would have to be paid into my retirement account. What about income and expenses? Go over that. What about any expenses for the property? Am I allowed to do any of the work for the property? Am I allowed to receive any management fees for managing the property? Am I allowed to stay in the property at all? If it was an Airbnb, let's talk about income, expenses, and usability.
Yeah. So a lot there. So if I miss something, just remind me what I'm. So the first thing is that yes. So there are rules around this. So one rule is that you are allowed to manage your account. However, you are not allowed to provide a service to your account, right? So what's the difference? Here's how I like to explain it. This is how I think about it. Management, so let's go back to that $100,000 property. Management, right? So you're allowed to manage your retirement account and manage the investments in it. So as an example, you're looking at 3 properties. You say, I think this one's a good investment, those other 2 are not. That's management, right? That's a function of management. You say, I'm going to rent this property for $1,200 a month, not $1,100 a month. That's management. You say, this tenant's a better tenant than that tenant. This contractor, right, I'm going to hire to paint the property, but he wants 20 grand. I'm going to pay him 15 and negotiate that. In my opinion, right, and this is just my opinion here, that's management. By contrast, a service would be, oh, wait a minute. You want to charge me 15 grand for painting? I can paint that myself. I know how to paint. I'll just do it myself and save myself 15 grand. Nope, that's prohibited. That's a service. So you're not allowed to provide a service. Another way to think about that is sweat equity, right? So you can't provide sweat equity to the account, so to speak, because that's a contribution. And by the way, there's a lot of reasons why the government or the IRS doesn't want us doing those kinds of things. One of them is, let's use the example that I just gave you. Let's say you provided that service and painted the property and saved yourself $15,000. I'm going to assume you're under 50 years old. That means your contribution limit to an IRA this year is $6,500. Well, if you just made a contribution of $15,000 in value to your account, that's called an excess contribution. So if you make an excess contribution to the account, you have to take it out, and there's some pretty stiff penalties associated with that. Well, how do you take out the painting? How do you take out the increase in value?
Yeah.
You can't. So see, now you got a problem. So this is one reason why I believe the government, in their infinite wisdom, wrote that into the rule book, right? No services being provided, right? So you have to think about it like a straight, passive, hands-off investment. So that's the service side of it. Now, let's say you have an Airbnb. Your Airbnb is not always rented. So the question is, well, okay, my IRA owns it and paid for it. Can I use that Airbnb when it's not rented? Right? It's not like I'm losing out anything. Well, there's a specific rule that says there's, and I'll cite two rules here. Two rules here on that. One is that there's no personal use, present or future, of any retirement account owned asset. So no personal use. And the other is an overarching rule, and it basically says that any IRA investment that you make is to be made for the sole purpose of the growth and appreciation of the IRA itself. There's not supposed to be any additional benefit to the owner, right, personally. So someone could argue, and I'm sure this is what the government would argue, oh, well, you bought this Airbnb in your retirement account, you rent it out, it pays for itself, and now you have a free vacation place, right? So no, we're not okay with that, right? That's personal use. You're personally benefiting from that investment, so you can't use that Airbnb, right? So no, so no personal use.
No personal
right?
use, basically.
Right now, and then the last thing I'll touch on, which I think you asked about, was can I pay myself to manage my retirement account? And that's been decided on now. So again, remember, we're looking at the rules. So the rule said, and there's sometimes conflicts in the rules. So one of the rules said you're not allowed to charge yourself unreasonable compensation for managing your retirement account, right? So that would imply, as long as it's reasonable compensation, you could charge that, right? Except the other rule says you're not allowed to personally benefit from any investment other than the growth and appreciation of the IRA itself. That seems to be in conflict. So interestingly enough, somebody tested that and actually paid themselves management fees from their retirement account to manage an investment, and the IRS took them to court over it. And the judge in that particular case sided with the IRS. So even though it was a conflict in the rules, they said, no, you can't compensate yourself. Now, here's the other thing I say about that. You wouldn't want to anyway, because if you're making money in the account and it's tax protected, if you paid yourself, now you're creating taxable income. So why would you want to take money from a tax protected environment and put it in a taxable environment? To me, that doesn't make any sense. It sounds logical at the beginning when people think through this stuff. Oh, well, this would be great if I could pay myself for this. Yeah, until you start to kind of dig down in the math and you're like, wait a minute, no, I'm actually giving more money to the IRS by doing that, right? And then the last piece that I think you asked me about was if you own that rental property or their Airbnb, does the income have to go back to the IRA, and how are expenses paid, right? So the general rule, all income, earnings, and profits return to the IRA for IRA-owned investments. All expenses are paid from the IRA for IRA-owned investments, right? So now where this comes up is where people say, oh, well, I'm 59 and a half now. I own a portfolio of rental properties. I can just have the tenants send me the rental checks. That's not how it works. The way it works is, the process is, when, regardless of your age, if the account owns the investment property, when the tenant writes the check, they continue to write it to the IRA, it gets deposited. When you want to take a distribution, and that's what it's called, you say to Specialized, hey, Edwin, send me the $10,000 that my account generated last month. And we send you a check. So it can generate money every single month, and we can turn around and send you that money, but that's actually the process that you have to go through, right? It has to go through your custodian. That all has to be properly record kept and reported.
Got it. I love it. So let's go along those same lines about like paying yourself in income and taking that from a non-taxable account to now I'm creating a tax liability for myself if I'm paying myself. I've heard this argument. I've heard the argument that it doesn't make sense to buy real estate and you're self-directed because real estate provides tax benefits and a self-directed account provides tax benefits as well too. So it's almost like you don't receive the depreciation benefits when you're investing in a self-directed account. So therefore it wouldn't make sense. What are your thoughts on that?
Yeah, so I've heard, it doesn't come up often, but that does come up. And so if somebody's making that argument and you're not super familiar with this, if you haven't really thought through that question, you're like, that does make some sense. Why would I want to give up those tax benefits? And there's a couple perspectives on that. My perspective is this: it's actually, when you start to get down into the details of this, it's a silly argument. Here's why. One of the reasons why, and again, we don't have slides today, so I can't show you the math, but one of the reasons why people use retirement accounts, and one of the reasons why for most Americans, their retirement account is their largest investable asset. That's where a majority of Americans' financial assets sit that they actually can invest with, right? Homes are included, personal residence, but that's not really an asset in the sense that you're going to do anything with it. You have to have a place to live, right? So the retirement account is most people's investable asset. Why is that? Why is that Why is that larger than their bank accounts? Why is that larger than their brokerage accounts? Well, the answer is because we're building wealth and creating wealth in a tax-protected environment. So money compounds much faster and larger, period, right? So you're eliminating, either permanently, depending upon the account you have, or temporarily, the taxes on the income, profits, those types of things in the first place, right? Here's the second thing. You've got to look at it from the standpoint of, where do I get my best return? And this is actually at the heart of the issue. So that argument assumes, when people make that argument, or they ask that question, they're assuming, well, I'm either going to buy real estate in my IRA, or I'm going to buy real estate outside of my IRA. So why would I buy it in my IRA? The answer is, it's not an either or proposition. It's not mutually exclusive. The answer is you can do both. If you make your best returns investing in real estate, if that's where you make your best returns, why wouldn't you invest your money and your financial assets in both places, right? Because why would you take a lesser return on an investment because you're going to forfeit depreciation? You don't need the depreciation. You're not paying any taxes. Like, think about why we want depreciation in the first place. We want depreciation because we are triggering taxes. And by the way, that's more like a loan, right? Because depreciation can get recaptured. Yeah. So a lot of people act like this is something permanent. It's like, yeah, have you sold real estate in the past? like, have you had to deal with, recapture depreciation? Like I have. So, that's like a temporary thing oftentimes for people. That's not a permanent thing. And then here's the final thing I'll say about that. Real estate is one of the top 3 asset classes that self-directed investors with retirement accounts invest in. It's in the top 3. And number 2 are notes, which are usually tied to real estate. Number 1 are usually syndications and private equity deals, which again, real estate. So if you were to look at the underlying asset in those top 3 categories of all self-directed retirement accounts specifically, real estate is number 1. So if it doesn't make sense to do that, why is it that's what most investors are putting their money into, right? So those are just some data points, and that's how I look at it, right? And so so that's my perspective on it.
Let me ask you this. Is there ever a stat that says, like the average return on a traditional account versus the average return on a self-directed account? Has there ever been a study on that? Like what that compares those two by any chance that you're aware of?
No, there isn't. And there's a reason, and there's a few reasons why, and I don't think there ever will be. Like the transaction you just mentioned, right? Most people can't put that together. Right? When I say most people, not in your audience, I'm saying most people in this country can't put that together, right? So if we were to use that and say, hey, you could expect a return like this, FTC is going to be all over this, right? So because it's so individualized, that's one issue. Here's the second issue. So I came from the Wall Street world. That's where I started my career, right? I left that world to come into this world. And so we were able to publish returns on specific investments, but that's all extremely regulated. So all those investments that report returns to investors, and mutual funds are a good example of this, they are at very specific timeframes, right? So the returns, in other words, are universal among all mutual funds that want to report historical performance. They're only allowed to report that on certain timeframes that are determined by the rules and regs, right? Mm-hmm. So, like, you have to publish those earnings and certain financial stats at the end of every quarter. So, like June 30th, right? You can get a statement or we used to call them snapshots of an investment, and it would have like numbers through June 30, right? It would have like 1 month, 90 days, 6 months, 1 year, 5 years, whatever. So all of that is highly regulated so that it's not used to mislead investors, right? So you can make an apples to apples comparison, and that's really what the government's concerned with.
I love it. Okay. So let's say I get to retirement age, and let's say that I hold property inside my self-directed account. Can that be distributed to me at that point? Does it stay in the retirement account? And also, let's talk about, we talked off camera about a strategy for somebody, like, let's say one day I plan on retiring. I want to retire in Santa Monica, California, and I want to buy a property there, but I want to buy it inside my self-directed account and then eventually move in there. Are there any strategies for that as well, too?
Well, there is. I kind of hate to share it with you because I think, buying real estate in California is a really lousy proposition these days. But, okay, if that's what you want to do, fair enough. So I had a client at a previous firm that I worked with, and so this was the scenario, right? He says, look, he lived in the Midwest, and the Midwest is full of snowbirds. I was in Miami last week. In fact, I hope my voice is coming through okay because I caught a bug or something on the way back from Miami. We spent the weekend in Miami. That's what we do, right? This time of year and into the winter, we go down to Miami or Florida, right? So this particular client said, look, I've got money in my retirement account. I want to buy a condo near the beach in Florida, and I want to buy it as an investment, right? I want to rent it out, and but I really want to live in it, right? Not now, right? But down the road when I get to when I'm ready to stop working, right? I want to move into this condo. Mm-hmm. Well, what did I just say earlier, right? One of the rules is it says no personal use, and it's very specific, present or future. So most people would answer that question and say, yeah, it's not possible. You can't do that. However, it really comes with understanding the rules, right, and how to use them compliantly to our advantage. So that's true. That rule is in place. So no, you can't live in it because your IRA owns it right now. And if your IRA owns it in the future, you can't live in it, right? That's what the rule says. However, there's no rule that says you're limited to distributing cash from your retirement account. You can distribute an asset from your retirement account. So what this client did was he bought the condo in a Roth IRA, run it out for several years. When he, at some point after age 59 and a half, when he was ready to make the move to Florida, he said, hey, distribute that condo 100% tax-free to me. And that simply means we retitle it, in this case, from his retirement account to his personal name. Now it's his personal asset. Now he can do whatever he wants with it, right? So now he moves into it. Now, again, that can be super, super powerful because think about this from from a planning perspective. Whether you're paying cash or you're using leverage. If you knew you wanted to be in Santa Monica 10 years from now, look, Florida real estate, unfortunately, is starting to look a lot like California real estate because a lot of people from California are going to Florida, right? Which is driving me crazy because I haven't bought into Florida yet. That's why we're going down there looking. If I could have bought 10 years ago, holy cow.
Oh, man.
Right?
Triple.
Right. So, but here's why I point that out. Because what if you had thought about this 10 years ago? You'd probably be doing some things today. The challenge with retirement accounts, because it's not immediate gratification, people say oftentimes, man, I wish I would have learned this 10 years ago. Okay, well, you didn't learn it 10 years ago, but think forward 10 years since you bring up 10 years, right? What if you bought an investment property that you could rent out you financed it in your retirement account, and you did that, and you structured that deal in a tax-free account so that as it's paid off over the next 10 years and as it appreciates in value, if that's where you want to live when you get to that point, then you can distribute it to yourself tax-free. What's the future value on that asset that you never have to pay taxes on, right? On that gain, that is. So thinking 10 years ahead, right? Because like I said, people say, man, I just wish I would have learned this 10 years ago. And I always tell them, well, be thankful you're learning it now, because most people don't even know it and they never learn it. But let's use that to our advantage. Think you didn't learn it 10 years ago, you're learning it now. So think 10 years ahead. What do you want your life to look like 10 years from now? Now let's back into that today.
I agree with you. Now, in that example, why is the Roth component key in that example, just for our viewers to understand?
Yeah, so there's two types of accounts, tax-free and tax-deferred. And those are terms that the government uses. So I just want to clarify this. In IRS publication 590, which the government publishes every single year, IRS publication 590 is the publication that talks about traditional IRAs and Roth IRAs. And so in there is basically a summary of the rules, right? Any changes from year to year, contribution limits, right? How things are treated, that type of thing. So in publication 590, Roth distributions, qualified distributions, so it's got to be a qualified distribution. Qualified distribution is jargon, which I try to stay away from, but a qualified distribution, because there's different types of accounts with different tax benefits. So qualified distribution is used by the IRS to refer to when you and I get the best tax treatment on the money we're distributing from our accounts, right? So different accounts, different tax treatments, but if it's a qualified distribution, that means we're getting the best tax treatment we can get in that scenario, right? So tax deferred or a traditional IRA, you get a tax deduction on the way in on your contributions. You get tax protected growth as the money's growing, but you pay taxes on the distributions. On the way. Not all the taxes we pay now, right? We get rid of FICA, FUTA, right? Social Security, Medicare. We get rid of those taxes. So we shave 15 to 18% off of what we pay on our income taxes. But you still pay federal, state, and local if you're subject to that. So if you are crazy enough to buy real estate in Santa Monica, California, then you absolutely, my friend, better use a Roth IRA or I'm going to come find you, right? Do not use a traditional, because you're going to pay state taxes on that distribution as well as federal and local. And we don't know what the state taxes are going to look like in 10 years from now, right? We know what they look like today. But here's the thing. Do that deal in Florida, no state income tax. So you have federal tax, right? And that would be it. If you use a Roth, no tax at all, right? It's a tax-free distribution. So that's why I would recommend, if you're buying an asset that you know you want to distribute the asset to yourself, look at the value 10 years ago. Let me just give you a perspective here. Are we okay on time? Because I know we're going over. And I'm okay if you're okay.
I'm okay with this. I love this topic.
Okay, because this is really important for people. Like, this is the kind of stuff that people just don't get this information. So here's an easy way to think about it. And I can draw some numbers. If you're looking and pick a specific property, make it very personal, specific to yourself, because that's where I say, when you can actually see your own account, or you see your own investment that you're thinking about making, when you can personalize the math to your situation, then it becomes very, very meaningful to you. So let's say you're looking at a property, and again, I'm just going to make the math simple. Let's say you're looking at a property and you could buy it today for $300,000. Okay, go back in Zillow or Realtor.com or in the county records, however you want to look at it. 10 years ago, if your time frame is 10 years from now, go back 10 years. What was the approximate value, market value, or what did it transact about 10 years ago, right? Back in that time frame. Let's say it was $100,000. Okay, so here's the strategy that I'm going to give you guys. Most people have their money in tax-deferred accounts, traditional IRAs. Why? Because traditionals were introduced in 1974. 401ks came out in the early 1980s. The only plan that most companies offer is a tax-deferred 401k. So most people's money is still in traditional. Roths were introduced through the Taxpayer Relief Act of 1997, right? You can start opening them up then in the late 90s. And So the government said, okay, well, we just came out with these, and we know some people are going to want tax free instead of tax deferred. But the problem was you got a tax deduction going in. And so what do we do about people? Because money going into a Roth goes in after tax, right? You don't ask the government for a tax deduction. That's why you get tax free income for the rest of your life. So how do we resolve this conflict in the rules? So they came up with something called a conversion. So, okay, the government is saying, we'll let you move money through a conversion from a tax deferred account to a tax free account, but you have to pay the taxes that you would have otherwise paid. So let me give you the scenario. Let's say in that scenario, right, you're buying it for $300 today. You're looking back 10 years ago. It sold for $100,000. Mm-hmm. Okay, so let's go back 10 years ago. Let's say you have $100,000 in your traditional IRA, mm-hmm. or 150, whatever it is you got in there. You don't have to convert all of it. You can just convert what you want. So let's say you're just going to convert over $100,000 to the traditional. You convert the $100,000 to the traditional. That is a taxable event to you, meaning you're going to pay taxes on it like it's like getting a 1099 for $100,000 added into your taxable income. But now go forward 10 years. You pay taxes on $100,000, but it grew to $300,000. That's $200,000 in a capital gain that you'll never, ever pay tax on. By the way, if you rented that out, let's just say you made $10,000 a year for the next 10 years. That's another, and that's probably low, right? But let's just call it, let's just be super conservative here. Just throw some math to it. That's another $100,000 that you'll never pay tax on. That's $300,000 that you'll never pay tax on. So one of the ways that I help people think through this is I say, look, when you're in, like, this is all the stuff that we do. This is where I say there's so much, it's beyond just an account. You really got to put together a plan and dial this in, thinking 10 years ahead, which is what we specialize in helping people do. And so that way you can make these kind of decisions, right, on the front end, because now you end up exactly where you want. And people don't do the future value, right, on what their cash flow or income or these assets could be worth. But in the event of real estate, I mean, like I said, that's why I use the example of Florida. If I could have bought it 10 years ago, holy cow, I wish I would have done that. Like, it's probably like prices in Miami probably are a third of what they are today. Right now, I don't know California because I don't shop California real estate market. I don't invest there, so I don't know what California looks like. But Miami, I can tell you, right? I've looked at it, and it's 10 years ago. I could have paid a third of what they're asking for the same exact property for today.
Yeah. I love it. And the thing about it too is that you don't know what taxes are going to be like in the future, but if you had to take an educated guess with all like the deficits that we'd have, you'd probably guess that taxes will likely be higher in the future. So when you have a tax deferred account, you basically have no idea what that's going to look like down the line.
Well, let me tell you what. And so let me touch on this. And again, I'll tell you this. At Specialized, if you look at our fee schedule, we will charge you the exact same fee for a traditional IRA as we do a Roth IRA. An IRA is an IRA from our standpoint. The fee is the exact same, okay? I don't have a horse in your race, but you do. So whatever you decide to do with your money is entirely up to you. Yeah. Having said that, I was having this conversation with a woman the other day. She's a friend, actually, friends of my wife and I, and we were hanging out, and hopefully they don't hear this because I'm going to say that the husband is so proud of making martinis that night. And I had one and it was so bad I couldn't have a second. I'm like, I'm just going to switch to champagne. Anyway, so we were talking and she says, well, I know you're in this business and I know, right, you do really well. I'm kind of curious what you think or what suggestions you might make to me, right? And so there was some conversation. I was asking some questions around it. And so I said, well, one of the first recommendations I would make to you is to open up a Roth IRA. And she said, that's funny. You know why? She says, my dad told me never open a Roth IRA. And he was a financial advisor. And I said, okay, why did he tell you never to open up a Roth? She said, well, because in my earning years, I'm in a higher tax bracket. When I retire, I'll be in a lower tax bracket. So why would I pay taxes now when my taxes are higher than in the future when they're lower? Okay, so this is where this argument falls apart, in my opinion. So let's go back to the scenario I just gave you. You got a $300,000 asset. 10 years ago, you could have paid $100,000 for it. You could buy it in a traditional, like this gentleman recommends, or you could buy it in a Roth, like I'm recommending. It's going to generate $100,000 in income in our illustration over that 10-year period. So that's a $300,000 capital gain. So, okay, let's say you're paying taxes at 30% on that $100,000 conversion. Or you make contributions during that period of time, and so you would have paid $30,000 spread over time, right? Because you're making contributions to a Roth. So you paid $30,000 in taxes on $100,000 that ended up in that Roth IRA. Give me the number that taxes have to go down to where you pay less than $30,000 on $300,000 in income and gains. It'd have to be a negative tax rate. The math doesn't work. Like if it was 10% tax rate, like on $300,000, I mean, right there's your 30,000. I mean, and so like, you know, it doesn't, the math just never seems to add up.
Not only that, but like the argument is that you're going to be earning less at that time. The whole goal is to be earning more at that time than less as well too. I imagine like I'm not planning to get to my retirement age and have less money than I have now. I'm actually planning to have more money than I have right now, as a matter of fact. At least that's the goal.
And by the way, when financial advisors say that, right, you're going to make less in the future than you do today, that's because that's what their investments and their strategies do. You make less in the future than you do today. I don't like that strategy. I certainly don't want to pay somebody a premium to help me make less in the future than I do today. I'm sure I could figure that one out just fine on my own without paying for it.
I want to make more.
I want to make as much or more. Right? Yeah. I have a number in my mind, and it's evolving. You know, it does bounce around, you know, based on my current lifestyle. I mean, I don't really have any bills. Everything's paid for. But, you know, I look at my current spend and I'm like, well, how much income a year, like to do everything I'm doing and have plenty of money left over and not have to worry about a thing, right? And so, again, when you get debt free, which I did a couple of years ago, right, which I was very proud of, finally did that a couple of years ago, right, in my early 50s, got debt free. That's a great feeling, by the way. My lifestyle is a pretty decent lifestyle. We do a lot of traveling, right? We enjoy traveling. We enjoy traveling the world. We enjoy first class travel. And fortunately, right, I'm in a situation where we can do that. Part of that is because, right, I'm debt free. But I don't want to make less in the future, right? In fact, I'd say I want to travel more in the future and do extended trips. Whereas now, because, right, I'm still involved in the business and running the business, you know, the longest trip we've taken is probably 3 to 4 weeks in Europe. You know, I really can't, I haven't figured out how to get away longer than that. And that's pretty long, right? Yeah. I did that for the first time last year.
Good for you.
And based on that trip, I was like, you know what? We need to trim these back a little bit, a week to 2 weeks at a time. That's it, right? But there's certain parts of the world you go to, you'd want to be there for a month or two. So that takes more income. That doesn't take less. So again, it comes back to what do you want your life to look like?
And this vehicle actually allows you to be able to do that. Let me ask you this question though. So like in that example where you gave where or let's say I buy a property inside my self-directed account. And let's say that the tenant trips and falls. Can they sue my IRA or my self-directed? Or is my retirement account protected against any litigation or lawsuit? Or is there any protection there for my for owning properties in my retirement account?
Yeah, so it's a great question, and most of the benefits that we've touched on today, and I think mainly in the past episodes, have really been focused on a tax benefit perspective, right? Mm-hmm. But the reality is there's all kinds of benefits to these retirement accounts. The thing you're bringing up is that, and I'm going to make a general statement. Okay, so this is a general statement. It does depend on a couple of factors, which I'll share with you. But generally speaking, your retirement accounts are judgment proof in all 50 states. What does that mean? If you personally declare bankruptcy, a court cannot attach a judgment to any asset or income stream held inside your retirement account. If you had a business that you declare bankruptcy on, the court cannot attach a judgment to any asset or income generated inside of that retirement account. If you were tried and convicted of a criminal offense, the court could take your life, but they can't take your retirement account. Now, that doesn't seem right, but that's the way it works. The two variables in that scenario, though, are, is it an IRA or a 401k? So IRAs are protected at a state level. So you have to look at the state rules and how those accounts are treated. But 401ks, which is another reason why we encourage people to consider the 401k when they qualify for it, is because those 401ks are protected at the federal level, right? So a completely different level of asset protection, way superior. In fact, when I talk to asset protection attorneys, asset protection attorneys, next time you talk to, say, give me your top 3 strategies to protect my assets. The number one, and I've talked to multiple asset protection attorneys, I'm kind of curious what they would tell you. They all tell me, keep doing what you're doing. Number one thing is maximize your contributions and investing in your 401k. That's the most bulletproof vehicle you can get. That's what the asset protection attorneys tell me, right? And I've talked to several about this to them. Now, that's from the outside going into the retirement account. Your question is different. Your question is, if my IRA owns the property, can a tenant with a slip and fall sue the property owner? Yes. The fact that it's owned by an IRA or an individual or a legal entity doesn't prevent liability. So because of that, there's different ways of dealing with that. Having said that, the number one way that I have always dealt with, most of my clients have dealt with, and most investors I know deal with that liability is insurance. Insurance is always the first line of defense, right? That's number one. That's not going to be different whether you own a property in an LLC, your personal name, or your IRA. Insurance will always be, in my opinion, the first line of defense. Now, if you're worried about it from there, there's some really cool asset protection strategies. So one is that some people say, and I like this, I'll give you one that I like better than this. Mm-hmm. Well, I could, if I'm going to buy 5 rental properties and I get a slip on fall on one, I don't want to sue my IRA and have access to all those assets. I hear what you're saying, Edwin, about insurance, but I don't want to risk all that. Okay. So people say, well, okay, can I use an LLC inside of an IRA? Yeah. So you could have your IRA invest in an LLC. The LLC could buy the property. You could have 5 properties in that LLC. You could have 5 properties in 5 LLCs and spread them out. The challenge is, though, right, depending upon how that all holds up, it's still one common owner, the IRA. However, so here's one I like better. Instead of separate LLCs, if you're really concerned about this, you set up separate IRA accounts. When you take title, so remember what I said earlier, when you take title, Specialized Trust Company, FBO, Jose's IRA, the account
more benefit of, yeah.
Right? Instead, what we're going to do is we're going to say Specialized Trust Company, FBO, IRA account number. And that's it. You are not signing the recordable docs. We are, because you're not purchasing it in your name. We're purchasing it. Your signature is nowhere to be found. Your name's nowhere to be found. If an attorney
looks through the records, they're not going to be able to find anything.
They're not going to know who the owner is. So what do they do? The attorney calls us, and the attorney says, I need to know who owns this IRA. And our response is, well, we're bound by a privacy policy. We're not allowed to share confidential client information. We're bound by the regulations. So you need to go get a court order and a subpoena. And then once you issue us that subpoena, we're going to have it reviewed by our law firm and see if it violates the rules or if we can respond to it and how we respond to it. Well, at that point, the attorney says, too much work. So he tells the client, theoretically, I'd be happy to take your case. That'll be a $5,000 retainer. The moment they say that to the tenant, it disappears. Most attorneys that file these lawsuits, I call it legal extortion. And for my attorney friends in the audience right now, not being critical, I'm just calling it what it is. Because attorneys have figured out if you have a business and you look successful, they can accuse you of something and it sounds really nasty in a demand letter. And they know that it's going to cost you and I, as a business owner or an investor, $50,000 in legal fees to hire a firm, because our firms we have to pay for. They don't work on contingent. And it's $50,000 before you even get to the courtroom. So they know if we send off a nasty gram and demand $200,000, it's probably good for 30 to 50K check in a few weeks, right? To avoid court. Yeah. So that's why I call it legal extortion. That's BS. So they're looking for a quick payday. Again, not making any claims here, but just saying the more barriers you throw up, the harder it is for people to come after you.
Yeah.
If you own 10 properties and the only thing that somebody searches on that county record is the account number, there could be 1,000 properties recorded in specialized name with different account numbers. They have no clue if any of them are connected to anybody else or not.
Yeah.
A lot of time, a lot of research, things that they don't want to do, right? They don't want to work in those cases, right?
So basically, even if they win a lawsuit, they can't attach a judgment to your, like, let's say that you didn't, like, that they knew that you were the owner. They can't even attach a judgment to that retirement account because they're protected by no judgment.
That's what I'm saying.
Right?
The owner is responsible, so they could sue for the value of that account. So this is what I'm saying. If you have a real legit concern, if you had 5 accounts, let's say you have 5 properties, each one is in its own account, then if they sue the owner and say, we want all the assets owned by this owner, right, because of this slip and fall, well, the only asset in that IRA is that one property.
That one account, basically.
And the other 4 accounts are completely separate entities, legal entities, right, completely separate. Mm-hmm. And, right, in theory, it has nothing to do with this case because this IRA only owns one asset.
Got it. What type of record keeping do I have to do if I own real estate? Meaning, like, do I have to do updated market analysis every so often?
Yeah, so good question. One of the things in the rules, and the IRS, we have ongoing conversations with the IRS about this because this is really, really important to them. They want, and what the rules state is that the custodian or administrator has to report the fair market value of the assets or the account value every year, annually, once a year, annually, right? Now, because these are all self-directed assets, right, non-traditional assets, it's really the client's responsibility to provide those valuations on an annual basis. In some cases, we can help determine that, and many clients ask, it's an easy way to get this done, and so we can talk to clients about that. But it is ultimately the client's responsibility to provide the valuation because it's not a marketable asset, right? It's not a mutual fund that, closes at the end of the day, or a stock that trades second by second that you can put a value on at the end of the day. So these types of non-traditional or alternative assets do need annual valuations. That's what the IRS requires in their rule.
Last question. I die. What happens to the properties in my retirement account?
Okay, so this is a great thing. So we talked about 2 benefits so far today of retirement accounts. Well, we've talked about several. One is taxes. One is accelerating our wealth, right, by avoiding the taxes. And controlling our money. That's another. I mean, that's actually the biggest benefit. We control what we do with our money. Asset protection. We talked about some asset protection benefits. Here's another benefit. Estate planning. Retirement accounts are the cheapest estate planning money can buy. I'm putting my estate plan together right now. My new wife insisted on it. Right? And actually I did too, because I'm like, I don't want my kids making decisions. I don't know. At this stage, I don't necessarily trust them. So I need to make sure this is all done correctly. Let me tell you what, to get an estate plan done, like most of the attorneys that I've been talking to, is 20 to 30K, right, to get these things set up. But here's a really cool thing about it. Retirement accounts, like I said, are a specialized trust. And so when you list out your beneficiaries, they bypass probate and go directly to the beneficiaries or your heirs. So there's some really, some of the cool stuff that we talked about now with conversions and where to buy assets and how to structure deals and lending and all, or borrowing inside the retirement accounts, there's some really cool strategies that you can do with the estate planning. So just to put it in perspective, let's say, right, so you're married, right? I'm married. Who lives longer, husbands or wives?
Wives.
Wives. I've never gotten a different answer. So what does that tell me? What that tells me is the wives are killing off the husbands. Statistically, that's a true statement. Okay. And you just told me I've never gotten a different answer from anybody on that. Okay. So what happens? So I've got an IRA. It's generating, let's just say $10,000 a month in income, tax-free from my Roth. When I pass, what happens to it? It goes to my wife. This is another huge benefit because, and this is why estate planning is important. Unfortunately, when one spouse passes away, that puts a financial burden on the other spouse. And it's late in life, usually, and that can be a real problem. But in this scenario, the problem is solved because what happens is when one spouse passes, the surviving spouse simply sends in the death certificate and says, switch this over to my name. So now, if I pass first, that $10,000 a month in tax-free income goes to Melissa instead of me, right? Boom, just right over. Now what happens after she passes? Well, then it goes to my four hoodlums, right? My four kids. And guess what? They can spend that money tax-free the day they inherit the account. So if you want to rewrite your family legacy, creating a self-directed retirement estate plan is one of the best ways to do it. One of the best ways to do it. Clients.
I love it. Yeah. It's funny because I met you at a mastermind group and you shared one strategy with me. In that mastermind group, I came back, I'm like, oh my God, this is like the answer to some of the challenges that I was having. And then we got it implemented. We went self-directed, and now we're doing a lot of different podcasts just looking to educate people on this topic, because I agree with you. Anybody that I've ever talked to, at least that is my age, it's very rare that somebody tells me, oh, I already self-direct. Most of the time people are like, I didn't even know that was a thing. And it allows them to take control of their retirement. So if somebody wanted to get in contact with you or your company, what is the best way for them to do that?
Yeah, so I'll give you a best next step. So if you go to the website, www.specializedtrustcompany.com, right? So it's just the name of the company. Again, get real creative here. Specializedtrustcompany.com. That's the name of the website. On the front page, I've got a special offer up right now where you can schedule a free strategy session with a self-directed specialist and get my latest book for free. You just plug your information in there, and then a rep will follow up with you. Our 800 number is on there too, so you can always just call in anytime if you want. If you prefer just to speed the process up, call the 800 number that you see there on the front of the website. And that's the best next step, because it's what people have now is like they have specific questions usually around, well, this is how much my account is worth, or I'm starting new, or there's just a lot of questions, and that's what those strategy sessions with our specialists is for, is to get all your questions answered and find out and explore, is self-directing right for you?
Got it. I want to say thank you, Edwin, for coming on the show. If you've enjoyed this episode, we did do another one on how to invest in real estate notes through your self-directed. We have another one on pros and cons of using a self-directed account. So I think that this is one of those topics that if you become very familiar with it, you could actually plan very well for retirement. So thank you, Edwin. In today's episode, we had Edwin Kelly, how to buy real estate through a self-directed IRA. If you've enjoyed it, hit the subscribe button. If you feel that this would be helpful, make sure to share it with a friend. Thank you again, and I appreciate your time.